Millennial Investment Strategies, a guide to financial success in your 20s. Number 1. Understanding the investment landscape. It's crucial to understand the investment landscape while investing. As Oswath Damodaran emphasizes in his podcast, traditional metrics like earnings and book value are essential, but they might not capture the full picture. These days, investing is more about discerning the shifts in the global economy, recognizing the impact of technology, and adapting investment strategies accordingly. Imagine you're embarking on a journey toward financial success. It is like planning a road trip. In this analogy, the investment landscape is like the map that guides your journey. A beginner investor should think of it as understanding the terrain and routes available to you. It is also crucial to recognize the shifts in the global economy. Picture these shifts as changes in the weather or road conditions. For example, the impact of technology is like discovering a new, faster route or realizing that some old paths are no longer efficient. So, just as you adapt your travel plans based on the weather or road conditions, investments also require adaptations. This adaptability is essential for making wise investment decisions. Number 2. The fallacy of market timing. There is a misconception among investors that market timing is a great stock investing strategy. This idea, that we can predict the market's highs and lows to maximize returns, is a fallacy. Though market timing is not a wrong concept, one's inability to implement it accurately makes it a fallacy. For all types of investors, it is better to focus on the long term. For beginners, who are in their 20s, time is the greatest asset. By adopting a patient and disciplined approach, one can benefit from the compounding effect and also weather the short-term fluctuations of the market. Imagine you're in a busy street market. There are numerous stalls selling various goods, and the prices of these goods fluctuate throughout the day. Now, as a young investor, you might think you can predict the exact moments when a particular item will be at its cheapest or most expensive. Is it practically possible? No. That is why timing the market is called a fallacy. Instead, a patient and disciplined approach is recommended. It is similar to patiently strolling through the busy market without the urgency to buy at every turn. Prepare your list of items, stocks, you would like to buy from the market. When you are in the market, try focusing on these specific items only. Go every day, and buy these items only when they are trading near to your preferred buy price. By adopting this strategy, you can benefit from the compounding effect. It is much like buying items that appreciate in value over time. Such items also tend to weather well the short-term fluctuations of the market. Number 3. Risk-taking. While caution is necessary, calculated risks are also a hallmark of successful investing. One must look for mismatches between our estimates of a company's potential and the market consensus. This involves a deep dive into understanding the company's fundamentals. It is also about recognizing when the market may be undervaluing or overvaluing a stock. Read about relative price valuation. High risk, high reward opportunities may arise during market disruptions. It presents us with a chance to capitalize on undervalued assets. Imagine you're considering investing in a company. This of it as if you are deciding to start your own business. This is where we must adopt caution but also encourage embracing calculated risks. This is the most critical millennial investment strategy. Let's say you're thinking about starting a small cafe. Caution would involve researching the location, understanding your potential customer base, and carefully budgeting for the venture. However, embracing calculated risks means you go beyond the obvious. You might notice that there's a growing interest in health-conscious eating in your area. Hence, you may decide to offer unique, healthy menu options. It will be a calculated risk that aligns with a potential market trend. Similarly, in the world of investing, you might like to buy stocks of such companies that have a unique business model but are currently trading at an undervalued price. Number 4. Diversification in the digital age. Technology has allowed millennials unprecedented access to the financial markets. However, it also brings new challenges. There are a plethora of investment options at our fingertips. We can invest in them upon the click of a button sitting in the comforts of our homes. One must spread investments across different assets. This will mitigate the risk of loss and will reduce the noise, volatility, in the portfolio. Imagine you're planning a trip to explore various regions of India. Now, think of each region as a different type of investment: stocks, bonds, cryptocurrencies, and more. Just as you wouldn't put all your travel expectations into one destination, you shouldn't put all your money into one type of investment. In this analogy, each region represents a different asset class. Stocks represent exploring bustling cities. Debt mutual funds are akin to tranquil hill stations. Cryptocurrencies resemble vibrant cultural experiences. Just as your travel experience gains richness from the diversity of regions you explore, your investment portfolio gains strength from diversification. Let's say you allocate a portion of your travel budget to experience the vibrant culture of Rajasthan, cryptocurrencies. The serene landscapes of Himachal Pradesh, bonds, and the dynamic urban life of Mumbai, stocks. Each offers a unique experience, just as each asset class contributes differently to your investment portfolio. Number 5. The role of education in financial literacy. Macroeconomic factors and global trends are beyond an individual investor's control. However, what we can control is their understanding of the investment landscape. Investing time in financial education is as crucial as investing money. One can do it through formal education, online resources, or expert insight. Staying informed empowers investors to make informed decisions and adapt to the ever-changing financial environment. Imagine you're preparing for a traditional feast, complete with a variety of dishes representing different aspects of financial knowledge. Now, think of each dish as a fundamental component of financial education: understanding stocks, comprehending bonds, and navigating through economic trends. In this analogy, the feast represents your financial journey. Each dish is a piece of financial knowledge you can acquire. Just as a well-prepared feast requires diverse ingredients, a successful financial journey necessitates a diverse understanding of financial concepts. Now, consider the macroeconomic factors and global trends as the spices that might influence the overall flavor of your feast investment. While you can't control these external factors, you have complete control over how well you understand each dish. This is where education comes into play. Number 6. The impact of inflation. Inflation has a profound impact on investment strategies. I believe that our 20th century economy was more predictable. The 21st century introduces a more dynamic and interconnected global market. Millennials need to account for the possibility that historical trends may not repeat themselves and be prepared to adapt their strategies accordingly. Think of your investment portfolio as a garden that you cultivate over time. Each plant in the garden represents a different investment, and your goal is to nurture and grow your garden into a bountiful harvest. Now, imagine inflation as the weather, sometimes sunny, sometimes stormy. Inflation, like weather patterns, can have a significant impact on the health of your investment garden. Never assume that the weather will always follow the same predictable patterns. Picture this: you've planted a crop that traditionally thrives in cool temperatures, assuming the weather will remain consistent with historical patterns. Suddenly, the climate becomes warmer than expected, inflation rises, impacting the growth of your crops, investment returns. To adapt, you need to choose plants, investments, that are resilient to warmer weather, inflation, or implement strategies to mitigate the effects. In the world of finance, this means considering investments that can potentially outpace inflation. Number 7. The power of long-term thinking. Millennials must focus on the long term. The jargon that dominates our financial news these days triggers short-term thinking. But millennials must ignore them altogether. One can gain a competitive edge by adopting a patient and strategic approach to investments. This involves recognizing that economic shifts and global trends unfold over extended periods. Imagine your investment journey as the construction of a magnificent building. Each investment decision you make is like laying a brick. The bricklaying is a crucial part of the overall structure. Now, consider long-term thinking as an architectural blueprint guiding the construction of your investment portfolio. In this analogy, short-term thinking is comparable to hastily assembling a building without a well-thought-out plan. Sure, it might rise quickly, but without a solid foundation and strategic design, it becomes vulnerable to market storms. Consider the stock market's daily fluctuations as the unpredictable weather. Your investment plan is the architectural design that accounts for the bad weather as well. If you focus solely on day-to-day market changes, it's like obsessively tracking every passing cloud. Instead, with a long-term blueprint, you're prepared for seasonal changes, occasional storms, and even periods of radiant sunshine. Conclusion. The investment strategies we have discussed till now can pave our path to financial success. Our investment journey is as important as the destination. Mastering these investment strategies involves a blend of prudence, calculated risk-taking, and a commitment to continuous learning. Drawing inspiration from seasoned experts like Oswath Damodaran, we can develop a personalized approach that aligns with our financial goals. It can set the stage for a successful and fulfilling financial future. The key lies in understanding the nuances of the market, adapting to change, and staying true to your long-term vision. Have a happy investing.